Hello friends, good evening to all of you, and today this is the 34th session for the BFM, and we are covering the complete classes in English only language for the CAIIB 2026 exam. So if you're preparing for the CAIIB, make sure to watch this series till end. And further, we are having the daily sessions from Monday to Saturday, and these sessions are held on at 9:15 p.m. on daily basis. So do confirm the audio video quality at the earliest. And if you have been watching our sessions for a while, and if you have been liking it, do subscribe to the channel if you have not subscribed the channel so far. So the audio video quality is working all fine. So we were covering the chapter related to the ECGC guidelines and the risks in the foreign trades. So the different policies by the ECGC and also related to the different type of risk. So we have already covered the different type of risk, and now we are covering the different policies by the ECGC, and we have already covered the standard policy and the other policies in the previous video. I hope that you must have gone through the previous video because it will be giving you an idea related to the content that we have covered so far. So we are going to start the session, and the topic for today video is going to start with the export turnover policy. In short, we say it to be the ET. So this video is related to the chapter number 7 from the module A of the BFM. We have already covered the chapter number 1 to 6, and also the module B have already covered. So let's just start the session. So it's about the export turnover policy first of all. So it's a variation in the standard policy. It's a variation in the standard policy. The standard policy was a short-term policy, like where the credit period is up to 180 days. There the policy was issued for a period of 24 months. There the particular policy was basically issued for a time period of 24 months specifically, right? So now we are going to learn about the export turnover policy. So it basically refers to what? It basically refers to a policy which is given by the ECGC, right? Which is there by the ECGC. And further, it's related to the variation to the standard policy, right? And further, it gives benefit to the large exporters. So the export turnover policy is basically for whom? It is basically for the large exporters, and for the all the exporters who are having the turnover, who are having the higher turnover, and who are likely to pay the premium over and above rupees 10 lakh in a year to ECGC. Those are going to avail this particular policy. They are basically entitled that they can be availing which policy? That they can be availing this export turnover policy by the ECGC. In what case? In which the premium which is paid by the exporters is going to exceed 10 lakh rupees per year, right? And this policy basically is going to be based upon the projection. Now the projection will be related to the export turnover, related to the exporter, and after that there is initial discussion related to premium, that what premium is to be paid by the exporter in the upcoming year, and based upon that what will be done? Based upon that, the policy will be offered to that particular person, and the adjustment of the amount will be made at the end of the year, like based upon the actuals. So an estimation would be taken. So let's say we are talking about the exporter, right? So estimation related to the export turnover will be taken, and let's say the premium exceeds the 10 lakh rupees window. So the person is entitled that they can be getting the export turnover policy, right? And let's say their overall premium for the year was basically 13 lakh rupees. So the adjustment will be made at the end of the year, right? And definitely additional discount can be given to them. Why additional discount? Because the particular person is already paying a very high range of the premium. So if there is particular increase in the exports beyond some particular projected turnover, let's say the exporter took the policy for 25 crore rupees of the exports, and let's say the export amount even increased rupees 40 crore. There was some window which was given by the ECGC that if you will be exceeding the export turnover from this particular range, will be giving you extra benefit. Now those benefit will be available to that particular exporter whose export turnover is even more beyond the brackets, right? So that's the amount related to, and validity of this particular policy is for 1 year. This is for 1 year, and higher discretionary credit limits can be given on the overseas buyers. Like the based on the total premium that has been paid by the exporter under this policy, like higher discretion credit limits can be offered to them. Those can be offered to them, and it will be based upon what? It will be based upon the projected export turnover for the coming year. It will be based upon the past export performance, based upon the working capital cycle of the exports, and based upon that, this particular policy will be offered to the exporter. Clear so far? Now let's move ahead toward the another policy, which is a consignment exports policy. The next policy that we are going to learn about, it's the consignment export policy. Now, what is consignment? Consignment is like you're not going to export the product directly to the importer, but you're going to export the product to the agent who is overseas, right? So consignment exports refer to the goods which are shipped, and those are going to be held at the overseas centers, and then it will be available, and further some agent will be selling the particular goods to the overseas buyers, right, when the orders will be received. So there is actually a time lag between the shipment and the actual sale. So the actual sale will not be related like you have made the export and the sale is done. No, the sale will be starting when the product is there in the warehouse, and after some time when the actual buyer will be there, then the sale will be happening in such a consignment export policy system. So as to protect the Indian exporters from the possible losses while selling the goods to the particular ultimate buyers, ECGC introduced this consignment policy so as to cover the risks which can be there under the consignment exports. In case of consignment exports, there can be some another risks. So we want to basically, ECGC wanted to protect the exporters. That's why this particular policy is there. Clear with that? And there are two types of policies. One is related to the consignment exports stock holding agent, and the other one, it is a global entity policy. The stock holding agent and the global entity policy under the consignment exports. In particular scenario, if you're talking about the consignment exports, you understood the point that what is a consignment exports? Like when the direct sale is not made to the importer, but it's like that you are selling the product, you are basically shipping the product to some agent, and further after that, the final export, final sale will be made right thereafter. So there is another risk which is available. So there are two type of the consignment export policies. One, it is the stock holding agent, and the other one, it is a global entity policy, right? First one, let's have a look at the stock holding agent policy. Now, this basic policy is going to provide the insurance cover when the goods are exported and stored with an overseas agent. Like the example just I told you, that you are exporting the goods and those are to be held with the agent, right? And further, the agent will be taking care of the sales. Agent will be collecting the amounts, and further will be remitting the amount to the exporter thereafter, right? So the stock is being held by the agent out there. So in that particular case, the policy which is given is the stock holding agent policy. It's a stock holding agent policy. So the overseas agent is an independent and separate legal entity. That's a basically first point related to it, that the agent is independent and separate legal entity. It's not associated with the exporter, right? And the agent's responsibility are related to what? That they are going to receive the shipment, they are going to hold the goods, they are going to identify the ultimate buyers, and for the selling the goods, collecting the amounts, and further paying the payments to the principal. And when the sales are being paid, right, the sales being made by the agent would be at the risk on behalf of the exporter. So the ultimate risk in the case of the stock holding agent, it will be with the exporter and not with the agent, not with the agent. That's the first kind of the policy that we are talking about. And the second thing, second policy, it was related to what? It was related to the global entity policy. It was the global entity policy. Now, what is global entity policy? This is basically for the large exporters. This policy is for whom? This is for the large exporters. Now, goods are being sold on consignment basis. In this scenario, also the goods are being sold on the consignment basis, but to their own subsidiaries. Let's say it's their own subsidiary to whom the export is being made. Like this subsidiary is there, some branch is there, some group company is there. Now, this belongs to the exporter. Let me write over here. This belongs to the exporter. That's the difference, right? So you're selling to your partner only, right? And the overseas entity is going to act as your consignee, is going to act as your distributor, right? So that's the case related to. And further after that, this was all related to what kind of policy? It was related to consignment exports policy. I hope that you must have understood that part. And after that, it's about the financial guarantees by the ECGC. Now, the ECGC even gives a financial guarantee. The ECGC even gives a financial guarantee. For what particular purpose? That is basically issued by the ECGC. What is ECGC? ECGC is Export Credit Guarantee Corporation. Guarantee Corporation it is. And the guarantees are provided to the banks and financial institutions. Let's say ECGC is giving a guarantee. To whom? ECGC is giving a guarantee to the banks, to the financial institution, that you should be lending to the exporters. And further, if there is any risk imposed due to the exporter, I'll be covering it because I'm giving the guarantee, right? So if there is any loss to the banks or the financial institution, that will be paid off by the ECGC. That's basically, the banks will be willing now that we want to sanction the loans to the exporters. So in a way, the exports are going to increase. Now, what is the main objective? First of all, the ECGC wants to protect the banks against the credit risk, right? In export financing, the credit risk is there, and ECGC wants to protect the bankers, the banks and the financial institutions. And also the ECGC wants to increase export credit facilities to the exporters, right? And definitely the exporters will be receiving the adequate capital from the bank finance. And definitely it's going to promote the international trade. It's going to promote the foreign exchange earnings, right? So the different guarantees are available. Like one, it is PCG, that is packing credit guarantees given by the ECGC. Other one, it is a EPFG. EPFG. One, it is packing credit guarantee. Other one, it is a export production finance guarantee. Export production finance guarantee. And the third one, it is related to post shipment export credit guarantee. So you should be memorizing pre-shipment credit, so pre-shipment credit guarantee, post-shipment credit guarantee, simple as that. And the one, it is related to the export production finance guarantee. So that's, we are going to cover the working capital finance for the export production purposes, guarantee for the working capital finance. It is clear with it, right? So ECGC is having the intention so as to protect the bankers, so as to protect the financial institutions. So when they are lending to the exporters, we want to cover the credit risk on behalf of the banks and the financial institutions. So it will be a extra additional security which will be available to the banks. Extra additional security that will be available to the bank, and definitely the exporters will be having the adequate financial support with them for the international export purposes. And further, loan can be given to the exporter like for different purposes, like for manufacturing, processing, purchasing, for working capital purposes even, right? For letter of credit purposes, right? So for different particular purposes, the loan can be given to the exporter. And the guarantee which was issued, basically it is issued for a period of 1 year. This is important. This particular point is important, that this is for 1 year against the proposal made for the particular purpose over there, right? And the claim is payable within 4 months. Let's say claim is, let's say default was there on behalf of the exporter. Now the claim is to be paid. In case of the pre-shipment credit granted is not paid within 4 months from the due date, the claim is payable, right? Basically, if it is the pre-shipment credit guarantee, like I told you, pre-shipment credit guarantee means PCG. If it is not paid, there were default in it, then it is to be, it can be claimed. The claim is payable in that scenario. Okay. The next particular topic which we are going to cover under this chapter, that's going to be very much important, and it's about the export credit insurance for the banks. It's a export credit insurance for the banks, we say to be wholesale turnover packing credit, or ECIB, or ECIB. Now, export credit insurance for banks, WTPC, we say simply. ECIB, WTPC. This is the most common name for this. So it's an insurance policy. First of all, it is what? It is a insurance policy, right? And further, it is basically issued for the export credit guarantee. It is basically issued by whom? It is basically issued for export credit purposes, and it's issued by the ECGC. It's a guarantee which is issued by the ECGC. It's an insurance, not a guarantee. Basically, it's an insurance policy which is issued by the ECGC to the banks, right? Now, this policy is going to protect the banks. Now, first one, it was the policy by the ECGC which was being offered to the exporters. The guarantee, or no, sorry, the insurance which was offered to the exporters. Secondly, we read about the guarantee which was offered to the exporters. Now, the ECGC is offering the insurance policy to the banks also. To the banks also. That's about the ECIB WTPC. ECIB, Export Credit Insurance for the banks. And for the WTPC means that is whole turnover and packing credit. WTPC, packing credit. So this policy is going to protect whom? This policy is going to protect the bankers, the banks, not bankers, banks, against losses which are arising on default by the exporter in case the packing credit has been sanctioned by the banks. So the bank has sanctioned what loan? Bank has sanctioned the pre-shipment credit, the packing credit, we say. The pre-shipment credit, the packing credit, one and the only thing. Now the pre-shipment credit is sanctioned to the exporter, and let's say the exporter defaults. In that scenario, ECTC is going to compensate the banks, right? And this policy is said to be the whole turnover because it's going to cover the complete packing credit portfolio of the bank branch, not individual exporter. So it's going to cover the complete packing credit turnover. Now, whatsoever the packing credit turnover is there with the branch, the complete packing credit turnover is going to be covered. Now, if any of the borrower in that particular portfolio defaults, that is to be compensated. That will be compensated by the ECGC. Clear with it? So that is about it. So it is issued by whom? It is issued by the ECGC. I'm just covering the important points now. So it is issued by ECGC to the banks. So and further, higher percentage of cover is available at a very low premium because we are covering the bank packing credit turnover, right? And bank is required to notify the limit sanctioned to their exporters. Now, whatsoever the limit which has been sanctioned by the banks, that is to be reported, that is to be notified to the ECGC within 30 days from the sanction. Within 30 days from the date of sanction, that is to be reported, and banks are required to take approval of the corporation if they are going to exceed the agreed value, that is said to be the discretionary limit. Now let's say the bank basically availed the ECIB WTPC. The bank availed the ECIB WTPC for 250 crore rupees. For 250 crore rupees, the bank availed this policy. And further, now the bank is exceeding this threshold amount. The bank has sanctioned the total amount of 260 crore now. The bank is to obtain the approval from the corporation. From the ECTC, the approval is to be obtained, right? And the limit is set to be what? The extra limit that will be sanctioned, that will be said to be the discretionary limit, right? Clear with it? Further, the premium and the cover available, that's going to vary from the bank to bank. It's basically depending upon the let's say if the more default rate is there, definitely in that scenario the more premium will be charged to that particular bank, right? So that depends upon the amount of renewal, that depends upon the turnover, that depends upon the let's say the defaults which have been claimed by the bank so far, right? So that's going to depend upon it. Further after that, it's related to the export production financial guarantee. It's about the export production financial guarantee. Now, I already gave you an idea about the different guarantees. And that is basically what? That is basically the export production financial guarantee. I've already gave the idea that it covers banks, like when they provide working capital finance. So when the bank is going to provide the working capital finance to the exporter, right? In the pre-shipment stage, in the pre-shipment stage, when the bank is going to provide the working capital finance to the exporter, that guarantee is going to cover is EPF. We simply say it to be the EPFG. Clear that? And moreover, the extent and premium is all same as that of the ECIB WTPC, but it is just for the working capital purposes. That's it. So it's for the working capital purposes. Kindly take a note for it. It is for the working capital purposes. After that, it's about the post shipment export credit insurance or post shipment export credit, right? Insurance, whatsoever you name it. It's about. Now, advances which are basically given against the export bills. Now, let's say the export bill is there. Now, export bill, if it is purchased, means it was a demand bill was drawn. If it is negotiated, means usance bill was drawn. And if it is discounted, right? Or sorry, in case of negotiation, it is said to be the bill of exchange which is drawn under the LC for negotiation purposes. And discounted means we are talking about the usance bill. We are talking about the usance bill or rupee finance by the bank when it is given, and for the guarantee for the same, that is basically post shipment export credit insurance, right? So if the post shipment credit is given to the exporter and the guarantee which is going to cover the same, that's basically what? That is a post shipment export credit guarantee. Post shipment export credit for the guarantee for the exporter, right? Like we read about the ECIB WTPC. It is what? It is the ECIB WTPS. Insurance is like what? That you're going to cover the bank. You're going to basically provide an insurance to the bank that whatsoever your portfolio for the post shipment credit, for the post shipment finance, we are going to provide you with the insurance cover. Like if there is any default or there is any credit risk on behalf of the when the bill of exchanges were drawn and were not basically repaid by the importer, in that scenario, the ECGC will be covering those losses. Clear so far? Do confirm if you have understood this particular concept. Let me just give an idea. So here is the exporter, draw the bill, and for the importer accepted the bill is with the exporter went to the bank for the discounting purposes. Now the bank has discounted the bill. This is a post-shipment finance which is allowed, right? Now the bank went to the importer for the collecting the bill for the payment purposes and the importer defaulted. Now, if the bank has an insurance cover from the ECGC for the post-shipment finance purposes, like we say to be ECIB W whole turnover, because it's covering the complete portfolio for the bank, and further it is post-shipment credit, PS, WTPS, not WTPC. PC is for packing credit. WTPS is for post-shipment credit. Not that will be covered, right? So higher coverage will be there at a very less premium, like I already told you. Okay, so that's about it. Further, it's about the EFG. It's about the EFG, that is export finance guarantee. Now, what is export finance guarantee? A comprehensive cover. Like it's a mixture of pre-shipment credit and post-shipment credit. Both will be covered. So we can say the pre and post-shipment pre and post shipment, both will be covered under the EFG, that is the export finance guarantee. So this particular guarantee is offered to whom, or the insurance will be offered to whom? This is offered to the banks. This is offered to the banks, right? And the complete portfolio for the packing credit limit, or let's say post shipment export finance, those both will be covered comprehensively in this case. Clear? And after that, it's related to the export performance indemnity. It's about the export performance indemnity. Now, it's basically a counter guarantee to the bank. Counter guarantee to the bank. Now, what is counter guarantee? Let's say a guarantee which has been issued by a bank in favor of the exporter. In favor of the exporter, right? On behalf of the exporter, a guarantee is given to the importer, let's say. So, a counter guarantee will be given by the ECGC to the bank. So, it will be a counter guarantee which will be issued by the ECGC to the bank, so that whatsoever the losses which are there, let's say the exporter was not able to fulfill the promise, was not basically able to give the performance, or the performance of the contract was not fulfilled. Let's say there was a construction contract with the exporter that was to be delivered, but the performance was not at par, and importer invoked the guarantee. The importer invoked the guarantee. Now the bank is to make the good loss. The bank is to make the loss good, right? In this scenario, the bank is to compensate. Now a counter guarantee is given by the ECGC to the bank. Now the bank can be recovering the amounts from the ECGC. That's the export performance indemnity. So it's a counter guarantee. Kindly please note on the important terms. It's a counter guarantee first of all, and further guarantees are required to be issued for the exporters, for the client purposes, for the performance of the particular contracts, right? So guarantees are also sometimes required for the purpose of customs, for the purpose of customs, right? Now in that scenario, a counter guarantee is given by the ECGC. Further after that, it's about the export finance overseas lending guarantee. Overseas lending guarantee. Now, what is this? Let's say, let's just consider that bank is financing the overseas project, right? Overseas project is there, right? And further, it wants to safeguard itself. So, as per the example, we can say here is a bank with us, which is in India, and further bank is going to provide a loan for the overseas purposes in foreign currency. Let's say the loan is granted, right? Now bank wants to protect itself. Now let's say if the contractor is here who is going to work there overseas, and let's say if there is possibility that the contractor will not be paying the amount back, right? So in that scenario, a guarantee is available for the banks by the ECGC. A guarantee is available. Let's say if the payment is not made by the contractor overseas, then the payment will be payable to the bank here. The ECGC will be compensating, and the payment which will be paid to the bank, Indian bank, that will be in rupees only. That will be payable in Indian rupee. Clear that? And after that, there are some special guarantees and schemes which are available. Like the first scenario, it's related to the transfer guarantee. It's a transfer guarantee. So let's say when a bank in India is going to add its confirmation to the foreign letter of credit, like I told you the case of letter of credit was opened by the applicant, like the importer is in there in the foreign country. Importer is abroad, right? And importer is going to apply for a letter of credit to the opening bank opened the letter of credit, and further it is given to advising bank here in India, but the beneficiary in India wants to add a confirmation from a reputed Indian bank. Let's say the HDFC bank in India adds its confirmation. They're going to add its confirmation, right? Now the HDFC is binding itself that, let's say, when a complying presentation will be done by the beneficiary, the payment is to be paid by the issuing bank, and also an unconditional undertaking is given by the HDFC bank that they are going to compensate the negotiating bank. Clear? Right? So in that scenario, the transfer guarantee can be availed. So transfer guarantee safeguards the banks in India against the possible loss that's basically is going to arise due to such kind of risk. Now, what risk will be covered? The risk for the HDFC bank will be covered, which was a confirming bank, right? And definitely, if the particular complying presentation was there, and let's say the opening bank in the foreign country is not going to pay the amount, that amount is to be compensated by the HDFC bank because it has added its confirmation. Now, this particular transfer guarantee will be available to the HDFC bank, that in case the opening bank is not able to fulfill its obligation, the ECGC will be compensating the amount for the HDFC bank. Clear with it? After that, it's about the exchange fluctuation risk cover scheme. Again, very important. Exchange fluctuation risk cover scheme. Now we want to protect the exporters, like the what's of the capital they are having, right? And let's say they are going to receive the payments over the years. So there was a contract between the exporter, and for the contract was, let's say, was related to the capital goods. Now you booked the contract in the year 2022, and the dollar price was then, let's say, 79 rupees. For rupees 79, you were able to get one particular USD, right? And let's say the INR appreciated. INR appreciated. So now particularly you're getting lesser INR for the same USD balance. The amount is to be exported to be paid in USDs. Let's say the amount is to be paid in USD, and the contract amount was for 5 million USD. We're just assuming the whole thing right now. I'm just giving an example, right? So there was a contract with the exporter for the capital goods, and the payment was to be received over the years. The total amount was 5 million USD, which was to be received. And the price in 2022, we are talking about, we are just assuming it was 79 rupees. And what now happened that the rupee appreciated, and you are now just getting after 2 years or 3 years, let's say in 2025, let's just assume that you are now just getting rupees 60 for 1 USD. The rupee appreciated. Let's just assume. Okay. Now what will happen? The exporter will suffer a huge loss due to this exchange rate fluctuation. Due to this exchange rate fluctuations, right? So the payments are received in the foreign currency, and when you're going to exchange it, definitely the particular exporter is going to face the risk because the currency may be appreciated or depreciated. So if the adverse effect is there, then definitely you're going to lose the money. So the cover will be available under this particular scheme. Under the scheme for the exchange fluctuation risk cover scheme, the cover will be available to the exporter. And if the contract period is exceeding 12 months and for the it's up to 15 years, the particular scheme can be availed for, right? And this is available for different currency. Let's say your payment is in US dollar, pound sterling, euro, Japanese yen, Swiss francs, UA dirham, or Australian dollar. You can be availing this particular scheme. You can be availing this particular scheme. That is basically what this is, a exchange fluctuation risk cover scheme. Clear with it so far? Do confirm at the earliest that you have understood the particular points. So objective is what? We want to protect the exporter from the loss due to depreciation of the foreign currency, right? And because there is uncertainty and you are going to receive the amount over the different years. So we want to cover the uncertainties over there. Clear with it? So there is some points that we need to remember in this scenario. First of all, if the loss or gain within 2% of the reference rate, that will be basically going to the exporter's account. This is important factor. So if there is, let's say, variability or fluctuation, gain or loss is up to 2%, that will go to whom? That will go to the exporter. But if there is loss which is exceeding 2%, ECDC will be making the good, right? So whatsoever the loss, that will make good by the ECDC, but not exceeding 35% from the reference rate. Not exceeding 35%. So if the overall losses are going to be beyond 35% of the fluctuation, then those losses won't be covered by the ECDC. So the fluctuation up to 35%, but above 2% will be covered by the ECGC, right? So that's about it. And also, if the gains are there beyond 2% or up to 35%, those will also be going to the ECGC account. So if there is any benefit also, that will also go to the ECGC. It's not like that the benefit will be going to the exporter and the losses will be the taken care by the importer. So up to 2%, the gain or loss will be with the exporter, but beyond 2% up to 35%, if there is gain or loss, that will be going to the ECGC account. The next topic that we're going to learn about, it's the maturity factoring. So I have already told you about the factoring. Now what is factoring? Now, whatsoever the amount receivables by the exporter, those will be factored and further will be paid in advance. And whatsoever the amounts those were to be recovered, those will be recovered by the factor itself. So maturity factoring is also the type of the factoring arrangement, simple factoring arrangement. In case of factoring, we are having three parties. One, it is a client. Other, it is a financier that we say to be factor. And further, the third party, we are having the debtors. So that's the case of the factoring. So the debtors are to pay the amount to the debtors. Debtors are to pay the amount to the client because client has shipped the goods to the debtors. Now these receivables are assigned to the financier. Financier will be giving the upfront payment, let's say up to 90% or 100% to the client based upon the agreement. And they are going to collect the amount on due dates from the debtors. That's it. Now it is recourse basis and without recourse basis. Both the cases are available. It may be with recourse basis or without recourse basis. So ECDC is a providing the full-fledged factoring services. Full-fledged factoring services. So factoring services are related to what? That whatsoever the receivables are going to be there in series of the transaction, or let's say in single transactions, those will be taken care by the ECDC factor. So whatsoever the factor company which is formed by the ECDC, that is going to act as a factor, and whatsoever the export proceeds which were to be received, those will be assigned by the exporter to the financier. That is a factor which is set up by the ECDC, and for the financier or factor is going to take care of the repayments. Is going to take care of the repayments. Clear with it? So that's about the maturity factoring. That's about the maturity factoring, right? So maturity factoring, as I told you, is a type of the factoring arrangement where the factor guarantees payment to the seller. Now, factor is guaranteeing the payment to the seller on a fixed maturity date, right? Irrespective the buyer is going to pay you or not. Irrespective, let's say the due date in this scenario was 23rd of August. Now, irrespective of the particular thing that the buyer, that is the importer, because the importer were the debtors. Now, irrespective of the fact that the buyer has made the payment or not, the factor is going to settle the payment on the maturity date, right? So, like I told you that advance payment is made by the factor to the client, that is not made in case of the maturity factoring. So now we are considering the case about the maturity factoring. Now in normal factoring, the advance payment of 90% or 100% is made, but this is not case with the maturity factoring. No advance payment is made there. And further, on due date, whether the payment is made or not, the payment will be made by the ECGC factor to the exporter, right? So seller receives the payment only on the invoice maturity date, only on the invoice maturity date. That's about it, right? So ECDC is basically going to facilitate purchase of the account receivables, provides 90% of the finance, full guarantee, maintenance of sales ledger, follow-up, etc. Now, who are eligible? The exporters with good track record are eligible. And further, if it is documentary acceptance terms, like on usage basis, if the particular bills which are drawn are on usage basis, those are eligible. And basically having unexpected bulk orders to execute, those are eligible in that scenario. Clear with it so far? Now, after that, it's related to the other aspects which are related to the ECGC policies and guarantees. Now, the credit guarantees and the policies are on risk sharing basis. It's not the case that the 100% guarantee will be given by the ECGC. Those are covering 90 to 95% of the scope, not the complete thing. 90 to 95% of the scope is covered. And those all insurance policies which are issued, or guarantee policies which are issued, those are under the purview of the IRDA, because IRDA is the Karta Dharta of the insurance policies and the guarantee schemes, right? And monthly declaration is to be submitted by the exporters, like whatsoever the turnover or something that is to be reported. Or let's say if you have sanctioned a loan, like if a guarantee is given to some banks, also the report of the exporter is to be given by the banks, right? That's the next point. So particularly in case of the whole turnover insurance policy cover which is issued to the banks, like even if you're talking about the whole turnover packing credit or whole turnover post shipment credit, the particular reference related to the exporters, the details related to the exporters, that is to be submitted on monthly basis within 30 days, that is to be submitted. And ECTC also prescribes the discretionary limits for the financial guarantee. I have already told you, like if the financial guarantee is given and the amount is exceeding, then you can be applying to the ECGC that you want to exceed the amount. Now that's basically as per the discretion of the ECGC. The ECGC that can be given. And further, the discretion limit for the financial guarantees up to the limit the banks are allowed to given. That's basically without the approval. But if further approval is to be taken, the notification, the report is to be sent in the prescribed format only. Only after that the ECGC will be allowing, and that will be admissible. And then it's related to the notice of default and lodging of the claims. Notice of the defaults and lodging of the claims. Now, under the financial guarantee, the banks are required to file with ECGC a notice of default. And in what period of the default notice is to be given? Within a period of 4 months, the default notice is to be given. The default notice is to be given. And further, the claims are to be filed. Like once you have given the default notice, that's to be given within the period of 4 months from the date of default, right? And further from the due date or from 1 month from the date of the recall, you have to give the particular 4 months, within 4 months that is to be submitted, the notice of default we are talking about. And further, the claims are to be filed within a period of 6 months from the date of lodging of the notice. So the default notice, when it was lodged, after 6 months of the same, you can be lodging the claim with the ECGC. Fine. Further, it's related to, since the policies and guarantees are on risk sharing basis, if there is any recovery which is made, a part of it will be going to the bank. Like, and further the proportion which was like paid by the ECTC, that will be going to the ECGC only. And for majority of the countries, the corporation places no limits so as to cover the political risk, right? And those are said to be what countries? Those are said to be the open cover countries. So for majority of the countries, for large majority of the countries, when the risk sharing or the risk covering for the political risk on 100% basis by the ECGC, those are said to be the open cover countries, right? But in case the country where the political risks are very much higher, the cover can be guaranteed on restricted basis. The political risk may not be covered 100% in that scenario. Clear with it? Now let's have a look at the difference between the standard policy and the small exporter policy. So standard policy is basically issued for the short-term exports, like I told you, where the credit period is up to 180 days. And the small exporter policy is basically issued on those scenario where your turnover is less than and not greater than 5 crore rupees. So if your turnover is up to 5 crore rupees, you can go for SEP, that is small exporter turnover policy. And this is also issued for the short term period. This is also issued for short term period. And this policy can be is available for 24 months, right? And this particular policy is issued for a period of 12 months. So the small exporter policy is issued for a period of 12 months. The standard policy is issued for 24 months. And further, this is issued to the exporters where the export turnover is greater than 50 lakh rupees. For 50 lakh rupees. And further, if your overall turnover is not greater than 5 crore rupees, you can be availing the small exporter policy, and the minimum premium which will be payable will be 5,000 rupees. and it's available in the different variants like comprehensive policies covered. Both the policies are basically available in comprehensive manner, which will be covering both the political risk and the commercial risk. Clear with it? So that's the difference between the standard policy and the small exporters policy. So that will be all related to this video. I hope that you must have understood all the concepts for this video. In the next video, we are going to start with the next chapter, that is chapter number 8. So if you really like the content, do make sure that you like this video and share this video. And if you want the PDF of this particular video, just simply WhatsApp CAIIB to the number 83609 44207, and full complete CAIIB course is available, where you'll be getting the full course videos, chapter wise previous year questions, case study videos, mock test, mega test, PDF notes, each and everything will be available. Just do enroll into the course right now. Just visit the link so as to download the application, or you can be visiting our website iibf.app. This is our website. You can be accessing it through your Chrome browser in mobile phone, or on the laptop PC, right? And if you want to download the application, that is available at this link iibf.info/app. Just do download the application, and in iOS, it will be asking you for the org code, which is GEGKT, and start your preparations right away. So thank you so much and see you again.